So today I'm going to talk about a stock that I sold at the start of the week. This is a stock that has not been a good performer in my portfolio, but as always, when I sell something on the YouTube channel, whether it's a good investment, I like to talk about why that investment worked out and why that was a stock that made me a lot of money. And when I have an investment that doesn't work out, same again, I like to talk about why that wasn't working out, what went wrong with that investment. And hopefully, as an investor, I can learn from that and I share that with you guys and look at the mistakes that I made with that investment. So I share this all on here to try and improve me and also try and help you guys as well. And as always, I don't try and hide anything. I always say what I'm buying, what I'm selling. If I have a stock that doesn't work out, I will not just tell you my winners, I will tell you the stocks that are not working out and why it didn't work out. I won't try hide it out. I won't try sell it quietly in the background. I won't start a new portfolio. I'm going to tell you what's going on. So today I'm going to talk about this stock and why I sold it. And this stock is one of my, I would say that as some of you guys that maybe have been following me for quite a few years, you'll know that around 2021, there was stocks that just went absolutely ballistic, and there's been a lot of stocks that have been absolutely killed from that time frame, which this stock is one of those stocks. And for me personally, there was that 2021 period where there was about 5 stocks that I bought that have been very bad performers. Now, obviously that's around about 15% of the portfolio, which isn't good, but at the same time, at least it's controlled to 15%. And at the moment, I'm trying to reorganize or strengthen the portfolio so that when we come out of the 2022 stock market crash, I have a portfolio that goes back to performing really well. And at the moment, I've been doing quite well with that, I feel like I'm building up some good positions in Google, DraftKings, HIMS, InMode, PayPal. I'm starting to build a really good portfolio again. So I'm trying to correct the portfolio, but there's those 5 stocks that I bought in 2021 that have stung me a little bit, and I'm trying to resolve that issue. And today, for one of those stocks, I thought that it was the end. I felt like I might as well cut my losses here before it gets a lot worse, because I do feel it's going to go worse. I feel like the company is heading towards bankruptcy, and even though I have to take a big loss on it, which I think was around about an 88-89% loss on the stock, at least I can get that little bit of cash out and then use that to another opportunity, and hopefully which I have used that cash to buy a brand new stock to replace it, which I will cover on the YouTube channel in a few days time. But hopefully I can use that cash into a new investment and help now recoup some of those losses that I had to take from this investment. So I hope you enjoyed the video anyway, guys, and if you could hit the like button and let's get started. So the stock is Beyond Meat. I did sell my shares in Beyond Meat, and the last year and a half has been very disappointing. Really, since the midpoint in 2021, the stock has been absolutely slaughtered. Now, the reason why the stock has been slaughtered is because financially it's not been performing that well, but also the negative market has pulled it down. But even if it wasn't for the negative market, I would still think this stock would be down 50-60+%, because financially they haven't been doing very well. Now, what I want to do is I actually want to step back to why I bought the stock, look at the reasons why I bought it, and see if those reasons I still believe in, or if I think, what was I doing in that sort of time frame. So Beyond Meat, if we go back to when I started buying the stock, which was around about 2021, the financials were actually not too bad. If you look here, gross profit was improving. It was actually 30% of the revenue. So they actually had pretty good gross profit margins. For a food company to have gross profit margins of 30% is actually pretty good. You've got a lot of room there to kind of start pulling up profitability. As well as that, the company increased revenue 11% year over year. They were actually growing. Now, what was quite impressive with this business at the time when it was growing is what you had the retail that was growing very well. You had retail in the US growing 27%. You have the retail in the international market growing 189% as they expanded into more and more stores internationally. So I was looking at the retail growth, that's absolutely amazing. I was looking at the food service, and the food service was declining 26%, and in the international it was declining 44%. But at the same time, you got to remember, this was 2021. This was like around the big CV times where restaurants were having to close or have limited service for a long time. So I was looking at these numbers going, well, if the retail holds up this strong and the food service goes back to the old numbers it used to do once the CV situation passed, that's going to help revenue grow at very good rates, and we're going to have a good retail growing business here and a good food service growing business here. And I was thinking, well, as soon as you have the bigger supply and the food service come back, your gross margins are going to improve once again. And the company was loss making, but it wasn't losing too much money, I would say, considering the expansion they were going through. And the thing is that a year ago I was thinking, well, they can get to profitability because last year they hit profitability. So I was looking at going, okay, they can get to profitability. It's shown it before. I was looking and thinking the revenue on the food service is going to rebound and the retail is doing very well. Add the food service back in, gross margins improve just because you're supplying that many products, and then you end up with a company that's near profitability, growing at very good rates with the food service business. It looks pretty good. And at the same time, what was happening is they were signing big contracts. Like they were signing contracts with Pepsi, and I was thinking, well, if Pepsi want to make a product with Beyond Meat, this is going to be a very good income once again, and hopefully this partnership builds up. And actually, it's worth pointing out this partnership was announced on the 26th of January, which if you actually look from this point of view here, the shares surged massively. And for me, that's actually when I first started buying the stock. And I actually remember selling, I think it was about 20% of my position out for around about 50% gain during that time frame. And that always does make me laugh. Like, people always talk about stocks going down, but at the time when this company was surging up in these partnerships with these financials, I was actually selling this company for good amounts of profitability, and I probably should have sold it all and walked away from the business then. You would have looked at that as a good investment. It does make me laugh the amount of times that people will talk negative about a stock, but then forget like they were up on that position, or the position was actually up for a good amount of time. I saw this the other day with something like a Boohoo. I remember Boohoo obviously isn't in a good place now, but people remember that stock was actually sold out for 100% profit one time before, and previously there was multiple times we were taking 50+% profit on Boohoo, but now suddenly it's the worst investment ever. Now I agree, because obviously you currently hold shares and it's down, but it makes me laugh how sometimes people forget about that there was a time where the stock was actually doing okay. Now fast forward from that time frame, how has this decline happened? Well, there was a lot of things that happened really. The first thing was the partnerships. The partnerships that we talked about did not digest into the revenue and profitability. We saw like the Beyond and Pepsi deal did not translate into good revenue. In fact, it turned into not good revenue, and also it hurt the gross margins, which is terrible choice by management team. That if you are going to do a product, you don't do a product that's going to hurt your supply, your revenue, because you're actually focusing on actually not making your Beyond Burgers and making these products, and then that product actually affects your gross margins. You had things like the McDonald's deal, which you were thinking were going to do very well, and a lot of that didn't end up working out. And what was really surprising is when you look at the data, you're looking at the data saying how much plant-based food is going to grow in the next few years, and it doesn't really translate into that. And it was a big massive learning curve for me, is that when you look at the statistics and saying, oh, this category is going to grow this much percent year over year, it sometimes doesn't translate into the revenue, which is key. And that was one of the big learning curves that I personally took from this investment. And the other thing as well is, I think when you look at it, the competition aspect, I think a lot of people saw previously how well Beyond Meat was doing, and there was a massive influx of competition, which I also did not price in how much the competition was going to kick in. Now, the other things that definitely have affected it is the fact that plant-based meat is more expensive, and you was hoping a few people were going to carry on that were buying vegan burgers maybe in 2021. You were seeing the increase in statistics. You were hoping people would be willing to pay that little bit extra to get that kind of plant-based product. Once again, that didn't happen, and especially now, this is one of the reasons why I'm selling now, is that I feel like we're going to have a bigger explosion in the cost of living crisis. I can't see why people would go buy Beyond Meat's products when they could go get a competition or competitor for cheaper, or they could go get real meat for cheaper. So if anything, this is one thing why I've sold it now, is that I only see this unfortunately getting worse if the cost of living crisis continues, because people will not be paying more for the Beyond Meat product. And this is also another thing that has frustrated me with the management team, is management team did say one of their priorities was to get the prices lower, but yet the prices are still not really dropping that much. They are dropping, but the only reason they are dropping in prices is because the gross margins is now coming down. So they're not actually bringing it down because they can afford to do it. They're only being forced to do it to try sell the products. And that leads you on to the recent financials. When you look at the recent financials, you can see here revenue was a big decline of 30% because the partnerships haven't worked out as you thought they would. And this is, what I'll say is that, you see these partnerships being signed and you assume, oh, if they've got a deal with Pepsi, it's going to work out really well. And it hasn't. Or you get a deal with McDonald's. people that like plant-based products will go and buy this from McDonald's. They haven't. So you see all these deals being signed and you can assume that they're going to translate to some form in revenue, and they don't. And that's definitely something that I've learned, is that you can see all these partnerships and you think the partnerships can be good, but until you see the improvement in the financials, they might look good on paper, but you have to see them actually be delivered. So that's obviously something that's affected the revenue. Gross profit, as you can see here on the recent quarter, was 2.2%. So you compare that to where I was buying this company a few years ago. The company was, what did you say, 30+%, was it, gross margins? Yeah, 30% gross margins. And they're having to sell their products for a lot cheaper because of the cheaper competition, the alternative, and the living crisis. And I think that living crisis might only get worse. And if you're making 2.2% gross margins, there's no way you're going to make profitability on that, because you've still got all your overheads, your admin, your selling fees, your marketing, your research and development. So this company, for me, is never going to hit profitability with those gross margins. And obviously revenue decline as well isn't great. And what they did recently is they changed the 2023 outlook. They said that their company operating environment continues to be affected by uncertainty related to the macroeconomic issues, including softer demand in plant-based meat category, which, like I said, I thought was going to increase, and it hasn't. I think also the thing that they haven't put in here is that people didn't carry on eating plant-based products from 2021 when there was the boom. I also think there's competition in there. High inflation, rising interest rates, and ongoing concerns about the likelihood of a recession. So they're basically saying that people are trying to save money and not buy the expensive plant-based products, which I think is true at the moment. And it's sort of not Beyond Meat's fault, but it sort of is, because they did need to bring those prices down a lot more and they haven't been able to do it. And Beyond Meat CEO Ethan Brown came out on the recent quarter saying about they're having to downgrade their guidance, and the quarter was way below expectations. It was absolutely shocking. But they said here that the back end of the year they expect a modest return to year-over-year top line growth in the third and fourth quarter, and relative to the first half of 2023, a meaningful reduction in cash consumption and an increase in gross margins. Now, that's all well and good, and if they do that, that will definitely help the stock. But the problem is that I look at Ethan Brown saying these things, and unfortunately, the last year and a half, really, he's been saying a lot of these things, and he's been under-delivering. And I don't like that by a management team. I don't like a management team that say something and they don't do it. I like management teams that say something and over-deliver. Those are the kind of stocks that I want to own. And he says this here, and to be honest with you, I just can't believe him. I can't believe the CEO, Ethan Brown, when he's saying these sort of things, because for basically the last kind of year and a half, 2 years, he's been saying things and they haven't translated into the revenue growth. The amount of times that they've put guidance out and I've gone, that's okay guidance, and they haven't hit the guidance, is nearly every quarter. The financial targets, they've basically missed every quarter. When they talk about the McDonald's partnership, it's not working. They talk about the Pepsi deal in a good way. It hasn't worked. So as much as the company would really benefit if they hit these sort of numbers. Potentially, if they were to hit these numbers, I could potentially be selling out in 6 months for maybe a little bit less of a loss. But the problem is how can I believe him? How can I believe the management team when all they have done previously is say things and then not hit them? And that's what I said. That's what ultimately I was on the Discord saying about this company, is that, do I carry on holding, and hopefully the days do get a little bit better and they do start turning it around, and they say that they're going to turn it around in the back end of the year. But I said the problem is that, for me saying this is that how many times have management teams said it and then not hit it? Imagine if we get to a point of view where we get to the back end of the year and they say that there's going to be an improvement, but then there isn't an improvement. If there isn't an improvement in the back end of the year, this company's absolutely knackered. There's no other word for it. They're going to be heading towards bankruptcy. So that's why I thought I might as well leave it now with a little bit of money that I can get out of it and use that somewhere else before it's too late. And if you look at the net losses now, they're increasing massively because they've not got good gross margins, which is very hard for them to even make profitability. The revenue growth's declining. The losses are getting worse. And the problem is you look at the net loss now, it's sitting at around about 53 million-ish. Let's just I'm going to do a bit of lazy maths. Let's say that's the same in the next 4 quarters. Let's say they lose 200 million, right? If you look at the cash and equivalents, the current situation is that the cash is 225 million. So basically, if they carry on doing what they're doing, they're going to be basically running out of cash in 12 months' time. So even if they do turn the business around, the problem is that in 12 months' time, they're still probably going to need a cash raise. And, you know, if you look at the company, they've already got, I think it's around $1 billion in debt. I'm trying to see it very quickly looking here. So yeah, outstanding debt was 1.1 billion. So once again, we're hitting a higher interest environment. They've got 1.1 billion in debt. Who's going to be wanting to lend money to this company? It's going to be really hard for them. You know, they're either going to have to try dilute shareholders, which will be awful. If they try raise cash, you know, I don't know who's going to do it. And if they do it, the interest rates are just going to be absolutely extortionate. So this is another issue that's going to happen in the next 12 months. So yeah, I just think that unfortunately, even if they hit if they do hit the higher numbers, they're still going to be burning through a ton of cash, and they're still going to be heading towards bankruptcy in a year or a year and a half, maybe 2 years if they can really stretch it out. And I don't think the company can turn it around in that time frame. So for me, I was like, you know, let's just cut it here. Let's just put it down to an investment that hasn't worked out, and it is disappointing. It's never good taking these sort of hits like this, but you know, it unfortunately is investing. It is the stock market. There is the risk there, and that is what's happened, and it has been disappointing. And hopefully, there's a few things I can take away from this as an investor. But it's key to have this is why it's key to have a diverse portfolio. Sometimes you can be sure something's going to work out, and it doesn't. And what I will take away from this investment is that partnerships are not guaranteed contributors to revenue and profitability. What I'll take away is that just because a category is going to be increasing by the statistics doesn't mean it actually translates to revenue and profitability, and also competition and how much competition can obviously affect a company. But the point of view that people will not be willing to pay a premium price for a product a lot of the time. People will prefer to buy a product that is maybe less quality but a lot cheaper, and especially in an environment that we're in right now. So yeah, hope you enjoyed the video, guys, and just a video for me sharing you guys with a change that I made in my portfolio. And like I said, I did use the money to buy a new stock, which I'll talk about on the YouTube channel maybe next week or the week after. Thanks for watching, guys. See you in a bit.